Tariffs aren't causing inflation. They're destroying corporate profit margins, the real danger. Complete 20-minute script for a retirement-focused audience. When you watch the news, you'll hear a lot of discussion about tariffs and inflation. The narrative typically goes like this. Tariffs on imports raise prices on consumer goods. Those higher prices push inflation upward. The Federal Reserve has to respond by keeping interest rates higher, and therefore economic growth slows. It's a straightforward story with a clear cause and effect relationship. But there's a different story happening underneath that narrative, one that's far more consequential for retirement portfolios. The real danger from tariffs isn't showing up in consumer prices, it's destroying corporate profit margins, and when profit margins collapse, stock valuations follow. Understanding this distinction is essential for anyone relying on investment income in retirement. Inflation is what happens when consumers pay more at the checkout. Margin compression is what happens when companies take less profit on every sale. These are two different phenomena with two different consequences for your portfolio. Let's start with what's actually happening in the real economy right now. As of January 2026, the United States has imposed tariffs ranging from 10 to 41% on various countries, with China-specific tariffs reaching as high as 49% in some categories. These are real costs. When a manufacturer imports components or finished goods subject to a 30% tariff, the tariff is a direct cost of doing business. The manufacturer can either absorb that cost by accepting lower profit or pass it to consumers by raising prices. The common assumption is that companies will pass it along, leading to consumer inflation, but that's not what's happening. The reason is straightforward. Consumer demand is weak. Households are carrying elevated debt loads. Disposable income has been squeezed. People are price sensitive. When businesses try to raise prices in that environment, they lose sales. So instead of full pass-through to consumers, what's actually happening is called margin compression. Businesses are absorbing the tariff costs by accepting lower profit margins to maintain market share and customer relationships. Research from Business Finance Analysis examining real-world data from e-commerce companies and consumer packaged goods manufacturers reveals a specific pattern. Companies initially absorb tariff costs through margin compression using existing inventory and accepting lower profitability to keep prices stable for consumers. This protected consumer prices from showing up in inflation statistics, but it came at a significant cost to corporate profitability. The data is clear on this point. When tariffs hit manufacturers' input costs, businesses have three choices. First, they can pass the cost fully to consumers through price increases, but this loses sales in a weak demand environment. Second, they can absorb the cost through margin compression, maintaining prices to consumers but accepting lower profit per unit sold. Third, they can reduce production volume and cut labor costs in anticipation of the demand softening they expect will eventually come when they do raise prices. The evidence shows that most companies are doing a combination of the second and third options. Consider the practical impact on a specific manufacturer. Suppose a consumer packaged goods company sources components from China at a cost of $10 per unit and sells the finished product for $25, generating $15 in gross profit per unit, 60% gross margin. When a 30% tariff is imposed, the component cost rises to 13. The company now has three options. 1. Raise the price to $26 to $50 to maintain the same profit. 2. Keep the price at $25 and accept a gross profit of only $12 per unit, 48% margin. Or 3. Reduce production volume because they know that when they eventually raise prices to $26.50, demand will fall, so they'd rather scale back now. What's happening in 2025 and into 2026 is primarily option 2, with increasing movement toward option 3. Companies are maintaining consumer prices to protect market share, but their profit margins are compressing. This is why consumer inflation from tariffs hasn't materialized as dramatically as many economists predicted. Businesses are eating the cost rather than passing it through. But here's where it becomes critical for retirement planning. When corporate profit margins compress, stock valuations compress as well. Stock prices are ultimately justified by corporate earnings and profit margins. If a company can maintain the same revenue but earns $12 per unit instead of $15, that's a 20% decline in profitability from the same revenue base. When that happens across hundreds of companies simultaneously, market valuations decline. This is why the narrative about tariffs causing inflation is partially misleading. Tariffs are causing something worse, corporate profit destruction, and corporations can only absorb so much margin compression before they're forced to choose, raise prices and lose sales, or maintain prices and watch earnings collapse. The Federal Reserve has been watching this dynamic carefully. In their recent assessments, they've noted that tariff-induced cost increases are being absorbed through business margins rather than flowing through to consumer prices. This keeps inflation lower than it would otherwise be, but it also means the damage is being concentrated on corporate profitability. and that damage compounds. Research from Yale University's Budget Lab indicates that the tariffs implemented in 2025 and continuing into 2026 will reduce corporate profits by an estimated $484 billion annually, approximately 15% of total corporate profits from 2024 levels. That's a massive margin compression. Some scenarios show losses as high as $1.5 trillion annually if consumer savings increase and the government uses tariff revenue to reduce the fiscal deficit rather than stimulate the economy. To understand how severe this is, consider the context. Total corporate profits in the United States are approximately $3.3 trillion annually. A reduction of $484 billion to $1.5 trillion in profits, 15% to 45% of total profits, translates directly to stock market valuations. The S&P 500 trades at a price-to-earnings multiple of roughly 24x. If corporate earnings decline 15 to 45% due to margin compression from tariffs, stock valuations decline by the same percentage. This is where tariff risk becomes a critical retirement planning consideration. A 15% decline in stock valuations is manageable for many retirement portfolios. A 40% decline is catastrophic for retirees drawing income, and the timeline matters enormously. If this margin compression happens over the next 12 to 24 months, and you're in your 70s drawing from your portfolio, you face the worst possible scenario, a sharp decline in portfolio value happening simultaneously with your need to withdraw funds. Let's examine what's happening sector by sector because the tariff impact is not uniform. Import-intensive industries, furniture, appliances, textiles, consumer electronics are facing severe margin pressure. Companies importing finished goods from China are experiencing tariff pass-through of 30 to 49% on their costs. Even with aggressive margin compression, there's a limit to how much profit they can sacrifice. Manufacturing companies using imported inputs are similarly stressed. A steel manufacturer importing raw materials faces higher input costs. A company manufacturing in the United States but importing specialized components faces tariffs on those components. The margin compression ripples through every industry with global supply chains, which is essentially all major manufacturing. Meanwhile, domestic-only companies or companies with less import exposure face a different dynamic. But here's the critical detail. Even those companies are under margin pressure because they're competing in the same market as companies that are cutting prices to maintain volume. If an import-heavy competitor drops prices to maintain sales in the face of tariff cost increases, a domestic competitor with less tariff exposure may be forced to match those prices to compete. The margin pressure spreads through competitive dynamics. One additional mechanism is making this worse. Companies are preemptively cutting production and labor in anticipation of the demand softening they expect will come when they eventually raise prices to consumers. This is a rational business decision. If you know input costs are up 30%, you know you'll eventually need to raise prices by 15 to 20%, taking some margin compression but not all. You know that price increase will reduce demand by some percentage, then you're better off scaling back production and cutting costs now rather than waiting for demand to actually fall and then scrambling to cut costs in a crisis. This creates a self-fulfilling prophecy. Companies cut production in anticipation of demand softening, which actually causes demand softening. Manufacturing production in the United States has contracted below the ISM 50 threshold, which indicates expansion versus contraction. Unemployment is rising. This is not inflation. It's the opposite. It's demand destruction in anticipation of price increases that haven't yet occurred. The economy is weakening not because demand is truly weak, but because businesses are preemptively scaling back in preparation for future weakness. For a retiree in 2026, this creates a specific danger. If you're drawing 4% from a portfolio that was expected to return 7% annually, and instead it returns 0% or negative, you're in a difficult position. The portfolio decline combined with your continued withdrawal depletes capital quickly. But this margin compression scenario doesn't just mean 0% returns. It could mean 20 to 40% portfolio declines if valuations compress, as profit margins compress. Here's a concrete example. Suppose your retirement portfolio has $1 million in diversified stocks. You plan for the portfolio to grow at 5 to 7% annually, which would support a 4% annual withdrawal, $40,000, while the portfolio grows. If tariff-induced margin compression causes corporate profits to decline 20%, stock valuations decline 20% as well. Your portfolio is now worth $800,000. You've lost $200,000 in 1 year. If you continued your $40,000 withdrawal, you're now withdrawing 5% of remaining capital annually. That's an unsustainable withdrawal rate. You've forced yourself to draw down capital faster than you intended. Now add another layer. If companies are cutting production and labor due to expected demand softening, unemployment rises. That creates additional economic weakness. The Federal Reserve, watching this unfold, likely maintains higher interest rates longer than would otherwise be necessary because the weakness is coming from business margin compression and production cuts, not from true demand collapse. So interest rates stay elevated, which means bond yields stay elevated and stocks face headwinds from higher discount rates. The key data point that corporate profits are under attack comes from the research showing that cost pass-through is only partial. Businesses are absorbing tariff costs through margin compression rather than raising prices to consumers. This is mathematically impossible to sustain forever. There's a limit to how much margin a company can sacrifice. When that limit is reached, and the evidence suggests we're approaching it in many sectors, companies will be forced to raise prices despite weak demand. And when price increases happen in a weak demand environment, sales fall and earnings decline even further. This is why the narrative about tariffs becoming inflation is partially wrong. Some tariff costs will eventually show up as consumer inflation. But first, before that happens, they're showing up as corporate profit destruction. The margin compression phase comes first. The inflation phase comes second, after months of deteriorating business profitability. Financial advisors are already noting the margin pressure in earnings revisions. Many companies that guided for earnings growth in 2026 are now revising those numbers downward, citing tariff-related cost increases. Earnings estimate revisions are leading indicators of stock market performance. When earnings estimates decline, stock prices typically follow within weeks or months. For someone in retirement, this creates an urgent planning question. Does your retirement plan assume profit margins remain stable, or are you prepared for the possibility that tariff-driven margin compression reduces corporate earnings 15 to 45% in the next 12 to 24 months? If you're not prepared, you need to make adjustments now. The adjustments could include several options. First, reduce your portfolio concentration in import-intensive industries like consumer discretionary, retail, furniture, and consumer electronics. These sectors face the most severe tariff-driven margin compression. Second, increase your allocation to sectors less affected by import tariffs, healthcare, utilities, consumer staples, which face some tariff exposure but have stronger pricing power, and international companies, whose margins are less exposed to U.S. tariffs. Third, reduce your withdrawal rate. If corporate profit margins are likely to contract 15 to 30% over the next 2 years, stock market returns won't be 5 to 7%. They'll be negative to flat. A 4% withdrawal rate from a portfolio returning 0% is unsustainable. Consider reducing to 3% or even 2.5%, which gives you a buffer in case valuations compress more severely than expected. Fourth, increase cash reserves. If a significant portfolio decline is likely in the next 12 to 24 months, you want to be able to cover your living expenses from cash rather than forced selling of stocks. This is called a sequence of returns buffer. If you have 18 to 24 months of living expenses in cash and bonds, you can weather a portfolio decline without being forced to sell stocks when they're depressed. Fifth, avoid selling quality companies during the margin compression phase, even if they report disappointing earnings due to tariff-related costs. This is a time when market panics are driven by temporary earnings pressure rather than deterioration in business quality. The companies with strong moats and pricing power will recover when tariff pressure moderates or is removed. One additional consideration: tariff policy could change. The Trump administration has demonstrated willingness to modify tariffs through negotiations and deals. If tariff rates decrease significantly, margin compression immediately reverses and companies' profit margins expand. This could be a positive surprise for equity markets. However, this is uncertain, and planning your retirement around an uncertain positive policy change is risky. Better to assume tariff pressure continues and be pleasantly surprised if it doesn't. The fundamental risk is that tariffs are destroying corporate profit margins through a mechanism that doesn't show up in consumer inflation. The Federal Reserve can't see this in price data and react accordingly. It just sees stable inflation and maintains higher interest rates, which compounds the pressure on valuations. Meanwhile, company earnings revisions decline, stock prices follow, and retirement portfolios contract just when retirees are drawing from them. This is why understanding the distinction between inflation, consumers paying more, and margin compression, companies earning less, is critical. Tariffs are doing the latter far more than the former, and the latter is far more dangerous for retirement portfolios because it directly impacts the earnings that justify stock valuations. Your retirement depends on your portfolio generating adequate returns in the years ahead. If corporate profit margins are compressed 20 to 40% due to tariff costs, returns won't be adequate even if consumer inflation stays moderate. The damage is real. It's just happening in a different place than the headlines suggest.